Hello and welcome back. In this video we're going to cover life insurance and the different types of life insurance that you may want to consider. Now once again I will caveat this entire video by saying that the actual advice on life cover should be taken from our regulated partners who will explain to you the reasons for the amount of cover and the provider who they are recommending. So this whole area would be covered by our regulated partners, but however Blue Bond can explain generically what these types of covers do and how they fit in with an inheritance tax plan. So generally speaking, there's two types of life cover involved in inheritance tax planning mainly, which is whole of life insurance. So it basically says that you are insured for your whole of life, and usually it's put into place for married couples who are both still alive, and put into place, and because the amount of insurance and the cost of the insurance is based upon the expected longevity of the youngest person. But there's two types of cover, one which is called standard cover and one maximum cover. So standard cover is put into place to pay out when the second person dies. In other words, a person would keep this plan until the second person died and pay for it that entire period, because you expect it to cover liabilities that are over and above, or inheritance tax liabilities over and above 1 million. So as we explained in previous videos, if the value of your house, your emergency cash, plus the value of your car and chattels and anything else you own is going to be over £1 million when you both die, and you can't see any way of getting rid of those assets beforehand while still maintaining your lifestyle, standard cover enables you to deal with that and pay a small, or pay an amount every month to cover that eventuality, so that the insurance pays out the plan and the payment is made into a separate trust for this particular plan, and inevitably the trustees of this plan have the money available to pay HMRC for the outstanding IHT liability. So why would you need a separate type of cover? Well, maximum cover is utilized to cover the amount of assets that you hope to give away during lifetime and before 7 years before the second spouse dies. So as I explained before, for most clients where they have quite large asset bases, otherwise they wouldn't have an inheritance tax liability by definition, they seek to give these assets away and into trust or directly, and it's the time taken that maximum cover deals with. Now you'll see in the split up, now okay, this is just Excel producing the effective diagram. The actual charges are not 30% of the premium. The cake represents the premium, but there is an element of charges, there is an element of life cover, and within standard cover there is an investment element, because this plan effectively is going to grow over time to pay out at some point in the future. Remember, you're holding this until the second person dies, and we know everybody's going to die, and therefore the insurance company knows everybody's going to die, and therefore they know this plan is going to pay out. Therefore there's an investment element to it which grows over time to effectively cover people. In some plans these days there isn't an investment element, and they just take the they charge the plan not relevant to stock market, because some people are nervous about the volatility of markets. So there's different types of even standard cover, and the regulated advisors would look into that and make the recommendation. But maximum cover for a similar level of cover is significantly cheaper. So sometimes it's 1/4 of the price for the same amount of cover. So people can place quite high levels of cover for relatively low monthly premiums, and that's the major benefit because it has no investment element. However, the caveat around that is that in 10 years time, because it hasn't got any growth element to it, it means that the amount of cover premiums will effectively double in 10 years time. But hopefully in 10 years time you've gifted away a significant proportion of your assets anyway. Remember, it takes 7 years to get it outside of your estate, and therefore the amount of cover you need should hopefully have dropped. Once again, the difference between these two will be covered by the regulated advisors. So let's sort of show that in a slightly different way. Once again, standard cover held until second death. The premium increases normally at RPI. The investment growth slowly over time, and the life cover also increases at potentially retail price index. So those plans can be quite expensive, and if that's the only type of advice you're given to avoid inheritance tax, it can be significant. So once again, worth looking at, but it depends on the person and the levels depend upon the person, and this is what our regulated partners will discuss with you. Whereas here you can see the maximum cover, the premium stays level or just increases with inflation, whichever's better for a person. After 10 years it goes up dramatically, again level or increasing slightly. But I'm trying to show here that every 10 years there's a significant jump in the premium, but the life cover either stays level or increases over time depending upon the advice that's given to you by our regulated partners. But the main point of having two types of cover is that effectively this maximum cover can cover a significantly higher amount in the current day for a significantly lower premium, because they know the premium is going to increase dramatically in 10 years because you haven't got this investment element backing it up. So that's the two types of life cover. Once again, this is just generic advice. If this is a requirement for you, then we will again refer you under your agreement to our regulated partners, and they will discuss this element in depth with you.